Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty. And today I'm going to be doing our weekly market update. I also want to tell everybody Merry Christmas and Happy New Year. I hope everybody's having a great holiday season, whatever holidays you're celebrating. Happy Hanukkah and all that good stuff. Hope everyone is having a great season. So, what I wanted to get into was our weekly market update. I'm going to start right off with some general numbers, and then we're going to talk about what the Fed had to say recently and where we're headed into over the next few weeks and months into 2023. So the close days on market right now, 64 days. That's the average close days on market. How long it takes to actually get a property, sold and out the door, close escrow on it. We've got a 3.95, almost 4-month supply of homes, which is actually it puts us right into a balanced market, which I'll get into more later. Our absorption rate is actually up a little bit. We were in a kind of more of a buyer's market. Now we're kind of more in a balanced market. So our absorption rate now is at 25.32%. So again, this is a slower time of year outside of some winter visitors coming in. A lot of people aren't buying homes right now, but it's also a great time to get some good deals because, people may be more apt to get something done by the end of the year, especially an investor or whatever, to close something out. A lot of builders are doing a lot of deals right now, a lot of incentives, a lot of closing costs. Going into the new year, tax season, and then when we get closer to when school lets out, for us, that's in May, things are going to start changing a little bit. We're going to see, a little bit more, competitive things happening where there's going to be more buyer demand and that sort of thing, which is just a typical seasonal cycle. So just always keep that in mind when we're thinking about, I read a funny article this week. It was, it was a headline. Let me see. I actually saved it here. Yahoo Finance. This was brilliant. Okay. Morgan Stanley warns that housing affordability is deteriorating faster than any point in its data history. Now, of course, a lot of times you read into these headlines and you actually read the articles and it's either like kind of clown showish or, it's actually not getting into what it should be getting into, what the headline is about. And they do that just for clickbait. That's how they make their money. That's how they get their advertising in front of you. So just always keep that in mind. But here are two simple ways to buck the worrisome trend. It says you can either buy now or wait and buy later. That's the brilliance of this article. So pretty ridiculous. Anyway, back to the numbers. Just to show you kind of what's out there. The average list price is $668,000 and some change. $517,000 is the average actual sales price right now. And I'll kind of explain that a little bit more here in a minute. But 517 is actually, really still, high on the mark for us. But that is actually higher than where we were earlier this year. So, equity is definitely going up. Well, let's see what's kind of driving some of this too, besides mortgage rates and supply and demand. There's another factor here I'll get into in just a second, and something just to kind of keep in mind. But the list to sales price ratio right now, which is always important, is 96.50. Now, we usually would say we like to see that just over 98% is kind of a little bit more of a normal for us here in the Phoenix area, kind of a normal, healthy type of trend that we like to see. So we're a little bit lower because people, again, at end of the year and with the higher rates and the higher prices, people are maybe having to do some adjustments with what's going on out there, especially with the seasonal aspect. So when we look at some of these numbers, here's some things to kind of put things in context a little bit more, besides what we always talk about, supply, demand, rates, all that. But the market share of what we have on the multiple listing service, are called Armless, are basically our regional platform on the internet where homes are listed for sale. And then they syndicate to Zillow, Realtor.com, and Redfin, and all the other brokerages and third-party sites out there. So when we look at this from 0 to 500,000 or 499,000, that makes up 58.84% of the entire inventory. Okay, all the supply. So almost 60%, 58.84%. So when we use these average numbers for especially the sales price, it is an indicator, sure, but keep in mind that the lower price range, things in the lower price range are we've seen a surge there since right around April, May, okay, and throughout the summer. A lot of investors and stuff were unloading properties, a lot of iBuyers trying to unload properties, a lot of iBuyers and investors overpaid for properties, okay, which kind of led to some of the hyper-inflated market that we had. A lot of them are going out of business, not doing iBuying anymore, or they're not offering anywhere near what they were offering before. It's just not a business model that can last long term, to pay 50 or 100 grand over what something's actually really appraised for. So, the great thing about this market is you can actually get in kind of a normal negotiation with people on both sides. Whereas a year and a half ago, it was like, you can't even, you can ask for whatever you want, but a lot of cases people weren't having to take offers that were even going to have an inspection or an appraisal. People were, coming from, California and places where it was super expensive compared to Arizona. And they were willing to pay the extra 50 to 100 grand because for them, it's nothing when homes over there may be 2, 3, 4 million or on up. For them to buy a $500,000, $2 million home here is nothing in a lot of cases. So, that really drove the market. And now we see that a lot of those homes have literally been sitting there for months and months and months with all these price reductions. Okay. And there's a very big market share for a lot of these investors and iBuyers and, people who just overpaid this year. And especially in the second, in the second, third quarter, maybe overpaid and then kind of got caught up with what was going on in the market. So, I see that inventory sitting there and it just drives the overall average price down with all that extra supply down a bit. Okay. So just within the context, let's keep that in mind because, if we actually look at, we've got homes for sale right now, personally, if you, and we've got clients with homes for sale, if you actually look at, the actual appraised value of these properties, it's not a matter of the actual appraised value on that home is really that much different. As a matter of fact, according to a lot of the appraisals we've been seeing, they've been coming in right at market value. In other words, what we would normally see, not the 50 to 100 grand over, but the reality of what these homes, were worth, 6, 7, 8, 9, 10 months ago, a year ago, without the crazy bidding wars. Okay. So, and they've actually gained in equity. And even looking at these round numbers, even going with the round numbers, okay, we're still looking at an average sales price from a month ago, just in November, up 2%. And then year over year, we're looking at, a 5% increase in the average sales price. So it's nothing, there's no crash. We don't have an over surplus of homes. We're not seeing that. I'll get more into that in a second. But I just wanted to kind of get that out there right off the bat so that, things make a little bit more sense than, some of the hype out there. Okay. So we see Wednesday, the Fed the Fed rate is in, range of capping the year off around their Fed rate at around, and their target's 2%. They're at about 4.25, 4.5. They raised the rates again, the Fed's fund rate again, point or 50 basis points. And then, earlier in the year, they were a little bit more aggressive with 75 basis point hikes that were happening every month. Remember, everything always lags a month as far as their announcements and what's happening. We won't see another announcement until February. Because they're off for the holidays. There won't be any in January. And for the new year, once they get back to the table, we'll probably see rate hikes happening, 2-3 more times till they're happy, so to speak. And we'll see that at about 25 basis points, most likely a pop. So let's get into this a little bit more. What does this all mean? And I'll be getting into the CMI here in just a second. But the what this means is it went from 7.7% to 7.1% year over year. So 6/10 drop. So what the Fed is doing is working as far as demand destruction. Again, we can all have our have our thoughts on the Federal Reserve, and how the economy works and all that. But in for what they're trying to accomplish, what they're doing, it's that part's working. Some keep saying rates are going to keep going up. But keep in mind, inflation always drives interest rates. So if inflation goes down, it always means that rates go down. Okay. Now, a lot of this is boring stuff, but basically you have to know what these data points are, what drives the market, what drives rates. So in the context, it's good news for rates for housing in the context, but for the economy, raising the Fed's fund rate is tough news, because it demand destruction means that it makes the economy worse. Okay, rates will go down because inflation will go down. And demand goes up for homes. For home purchases. From the standpoint of the fact that, hey, lower rates, right? Now, if somebody needs to buy a home or they have to buy a home, they're going to buy a home regardless of the rates. And right now you can get 2-1 buy downs, 3-1 buy downs, all those sorts of things. You can get all kinds of concessions and great deals right now. I think that's going to shift a bit, or at least not be quite as strong as it is right now when we get into the new year. And the further we get into the new year, of course, the government just, passed this omnibus, which is going to, more inflationary factors there, because you're printing more money to, many dollars, chasing too few goods. Okay. There is going to be in March, we are going to see a bit of a flux in some of the supply of that money that was already put out there for all the other stuff that we went through with COVID and all that other stuff. So that part was good. So we'll kind of see the standoff on that a bit, but I think overall we're going to see inflation coming down due to the cost of doing business, the cost of borrowing money, basically, and demand destruction and taming inflation from what the Feds are trying to do. But this also, of course, means layoffs, slowing in product development, slowing in growth. Stock market takes a hit. We're even seeing the bond market take a hit, which is tough, So, but as we go through this short-term pain, to fix things, if something grows, because we got to keep in mind, if something grows like 7% a year, in 10 years, the cost of a car is going to double and those sorts of things. So, the Fed needs to fix this, since they waited so long to fix it in the first place, and the way the whole structure the economy is. And again, we can debate that another time and whether or not you like the Fed and how the economy works. But obviously capitalism still gives us the greatest economy in the world. But in any event, without getting too far into that, I don't want to get off into a tangent. This week, the Fed's fund rate again was raised 50 basis points for mortgages. Doesn't really mean anything that was already baked into the rates and everything. We're going to see again a trending down with some fluctuations. Okay, 2 step forward, as I mentioned before, 1 step back. We are going to see, right now in the near term, fluctuations between 6.5% to 5.8% for a 30-year conventional. And so, get depending on the day, the time, the week, all that, we could see a fluctuation of, 25 basis points, depending on the day and the week and all that, and the hour and how things are going that day. But the difference is going to be depending on government loans. The difference on government loans would be that, we're probably going to see them, stick around around the fives. Okay. After the CPI report, we were down under 6%. Rates went way down, and then up and then stabilized. So the Fed is trying to slow the economy to lower inflation. And when that happens, rates trend down. Okay. So the next meeting again is February 1st. We'll keep an eye out on that. The best guess we'll see, again, 25 basis point hikes from them. We'll probably see them want to get up to about 5.1% or so. And then for the Fed's rate this week, we're at 4.25. Okay. So, we always see, I'm going to share my screen here with you real quick. And okay. There we go. Okay. So we always see, the projection that they gave us, Jerome Powell gave us is, over the next few years to 2025, they're going to try and get down to their projections, get down to 2%, on the their rate, okay, of inflation. That's what they want to get us down to. Okay. So we have to understand that, always when the economy is bad, in a way, it's good for the way people make, generational wealth. The easiest is through real estate. And it's good as long as you can keep your job. So in a bad economy, rates go down, basically, once they get the inflation tamed, and we are in a recession. For all intents and purposes, we're already in a recession, but they usually announce it after the fact, as I mentioned before. But this is really bad for markets, bad for jobs and all that. But we may see that jobs take a hit for sure. But even if we're, let's say, I think right now let's see, where were we? I have we were at right around 3.7 on unemployment. Even if we're at like 4.6, which is some people are projecting, we'll see, obviously we don't want to see anybody lose their jobs, but this is something that they want to see, believe it or not. It kind of doesn't make any sense. But if they see people losing their jobs, people don't have their jobs, they're not spending money, right? So that's kind of how this crazy cycle works. So with demand destruction, you can't have that extra inflation if people aren't able to spend the money. So in the Federal Reserve's mind, when they see unemployment go up, so when unemployment's low, that's actually at a time when a recession generally what happened because things are going well, right? So when they're doing their demand destruction, this tames the whole market. Businesses can't hire as many people. They lay off people. They're not doing their product development. They're not, growing. So we see people go on unemployment, have to go and get second and third jobs, and that's the thing with a lot of these jobs that came, were coming out like, ooh, the jobs report is quote unquote better than we thought. But, unfortunately, a lot of these, a lot of our economy and a lot of these jobs are based on services. Now, we don't really do as much manufacturing we used to do. Unfortunately, I know we're trying to get that back, or going to some of the newer manufacturing and all that with the chip design, and that's great. But a lot of these jobs are service jobs, second jobs, third jobs, even. When you break them down, at least half of them are these type of jobs. So, people are trying to keep up with inflation, and they're having to do all this extra work, all these extra hours, all these extra jobs in order to keep up. Okay. So people are getting stretched. So unemployment, or employment is a key indicator, key factor to watch. As unemployment goes up, rates go down. Okay. So that's not going to beat us up as bad. So you got to keep in mind the last recession we had, big recession we had in 2008, that was due to the housing economy. Okay. All the other recessions, housing's always been the Robin Hood of every recession. Okay. Because rates go down, and then we end up, with people wanting to buy homes because it's more affordable from that standpoint. Okay. If they have a job. Okay. So if we see around, let's say, just to kind of throw out some numbers, if you see kind of some indicators to watch into 2023, see around 5 million transactions. If we see things hover around 5.5% eventually as we trend down with rates, because we know 5.5, right in there for conventional. Now government loans, they're always going to be lower. Okay. I don't have time to get into the details of that, but as far as conventional, if we hover around 5.5%, do about 5 million transactions for the country. Okay. We're going to see kind of a normal year, a professionals market from the standpoint of the business. We're going to see all the discount brokers, all the fly-by-night companies, all the crazy iBuyer schemes, and, all these nutty, here today, gone tomorrow type of business models in the real estate business, kind of, fizzle out, which we've seen, Redfin again, on the stock market getting under $1 a share. Redfin's not buying homes. They'll not doing the iBuyer thing. Open Door is, but they're offering way, 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 way less than they were, even, 7-8 months ago. So I think, we're going to see a professionals market, the part-time LO, the part-time, realtor, and these sort of people who kind of jumped in over the last year or two, for the anomaly, just to make some quick bucks or get in and think it's so easy. We're going to see a lot of those people go out. We'll probably see, a lot of that fizzle out. Buyers are going to get some good deals, nothing crazy. Sales times will be normal and prices typical. For the Phoenix area, what does that mean? About 5-7% equity. Equity gains, which again for us would be pretty normal. Nationally, 2 to 3%, maybe 4% equity gains. Okay. Transactions will probably be overall, okay, because we had the anomaly year of all the crazy sales and investment companies and stuff coming in and buying everything up. We're probably going to see about 20% less transactions. But again, if we're around that 5 million mark, keep an eye out for that overall for 2023. Nothing like the anomaly year. This will be a professionals market. The realtors, we'll probably see about 200,000 less realtors. So there'll be a little less of that part-time influence, the fly-by-night type of deals. Like I said, the part-timers, the iBuyer, the discount stuff gone. So people who are professionals have the correct business model, we'll be busy. We're still busy, so I'm thankful for that. Thank the Lord for that, and thank all our clients for that. And thank you all, by the way, who came to our Christmas party. That was a lot of fun. Had a great time. Everybody got a pie and a candle. We got to see all of our clients. We like to do that. We like to have two or three parties every year for our clients. So that was a lot of fun. But anyway, a couple other things I just wanted to give you is the active listings. Okay, this is nothing under contract, just the active listings out there on going back to Phoenix, the Phoenix metro area market. Right now we have 18,608, so a little less, back the last month or two, 2-3 months, we've seen a little bit of a decline in the inventory. We were at like 19 and 20,000. Now we're at, like I said, just over 18,000. Again, seasonal thing. Also, keep in mind, a lot of people just don't want to put their market up during holidays, so there's that sort of thing. Keep in mind, when we had the crash back in 2008, there were over 56,000 homes on the market here in the Phoenix area alone, Phoenix metro area on the MLS here. So we're nowhere near that. We're nowhere near that supply. We're not seeing any super trends in foreclosures. When we see that foreclosures are up year over year, yes, because last year people weren't allowed to foreclose, or they had the safety net from the government due to the pandemic. So you have to always, again, put these things into context. Now, the Cromford Market Index, let's take a look at this. This, again, will indicate what I said earlier makes sense now with this Cromford Market Index. The CMI, again, Cromford, people over at Cromford are our local gurus, basically tied into our MLS. They track all the data, give us all the the great numbers of what's going on in Cromford Market Index. Let us know what kind of market we're in right now and probably what we're trending to. So the overall CMI right now, if we look at it, first of all, 100 is a balanced market, or between 90 and 110 is kind of within that balanced range, 100 being perfect balance. Over 110 is considered a seller's market, and on the index, under 90 is considered a buyer's market. So right now we are at a 91.8 overall, 91.8 overall on the Cromford Market Index. So, we're right in that balance range. A little lower than 100, but we're right over that 90 mark. And then for the demand, we just saw that go up a little bit over the last week or two. And nothing crazy, but it's at 71.2. Again, time of year, high rates, high prices. No surprise that the demand is low. So, trying to get to 100 at complete balance, we're down 29 or 28.8, on that index for demand. So, but supply is almost running about the same. Now, keep in mind, when these numbers are the same of supply and demand, we are in a completely balanced market. Right now, we're close to balance on the overall index, because the supply is at 77.6. Again, 100 would be complete true north balance, okay, or between 90 to 110. So to get to 100, we're at 22.4 on 22.4 low on supply. So the supply is keeping us out of trouble by being low, from the standpoint of the demand is low also, time of year, rates, prices, right? But what happens if the demand goes up once the rates start trending down, and we just get into the time of year where people are doing more buying and selling? There's just more activity going on. Well, we'll have to wait and see if that supply ticks up too. And remember, somebody selling a house and buying a house, maybe even an investor who's selling a house and then moving on to his next project, it isn't necessarily new inventory. New inventory is really like new builds, new product, new homes. Okay. And in order to keep up with that nationwide, there's there's got to be enough inventory there. And I've mentioned this a million times, but we're nationwide, we have an inventory shortage also. And right now we're just kind of in an activity slowdown, okay? A short-term activity slowdown due to the fact that there isn't as many options out there for people of product or supply. The rates are higher. So maybe some people got priced out, but as they trend down, especially once we know that 5 to 5.5 is kind of that sweet spot where people can now begin to afford again. Why do we know that? We know that because back during July and August, we saw a pretty big surge when we had a dip in rates to that 5.5%. Huge surge in our market. So we know that's the sweet spot where things start opening up again. Then you go into the already normal busy season. Again, every year it kind of looks like this. We get, into the fall and winter, things just slow down. It's just a natural occurrence. Yeah, you get some, people who are winter visitors and all that. But in general, and those are select markets typically. Overall, they can go anywhere they want, obviously, but a lot of retirement communities out here. So, all right. Now, as far as the cities around the valley, without going through all of the ones that are up on the Cromford Market Index, which means they're going towards a seller's market, or trending up on the index. Okay. Again, over 110 would be seller's market. But the only cities that are not trending up are Scottsdale. Believe it or not, usually they're one of the ones that are. If anybody is. The other two are Goodyear and Maricopa. Everything else is trending up towards balance or seller. So the cities right now that are technically in a seller's market, however, still over that 110 mark: Paradise Valley, Scottsdale, Cave Creek, Fountain Hills. Kind of like a broken record. A lot of those are usually in there. In balance right now, we see Chandler, Phoenix, Glendale. Okay. Chandler, Phoenix, Glendale. Everything else is technically in a buyer's market or below 90 on the index. Okay. So guys, that's all I have for you this week. I will definitely be doing more of these. It's been kind of crazy. We've actually been very busy. Anecdotally, we're not seeing too much of a slowdown, just, a little bit of a lull, but we've been very busy. And I, again, with you throwing holidays, it's been kind of crazy. Then we had our party last week, which, again, thank you all for coming. And we'll try and do another one of those coming up probably around springtime or just before spring. So guys, have a Merry Christmas. Hope you have a great time, maybe a little time down with family and stuff to enjoy the holidays. And we'll see you in about a week. All right, guys. Thanks a lot. Thanks.